The credit score was invented in 1956 by a data analytics company called Fair Isaac Corporation. You know them as FICO. They did not invent it to help consumers. They invented it to help banks decide who to lend to and at what interest rate. The score was adopted widely by lenders in the 1990s. And since then, the financial industry has done an extraordinary job of convincing you to care about a number that was designed entirely for their benefit, not yours. Understanding this does not mean ignoring your credit score. Your score affects your mortgage rate, your car loan, your insurance premiums in many states. It matters. But most people are optimizing it wrong. And the wrong optimization is costing them money. Your FICO score is calculated from 5 factors. Let me go through them and tell you where people are wasting energy. Payment history, 35%. This is the most important factor by far. Pay everything on time, every time. Set up autopay for at least the minimum. This is non-negotiable. Amounts owed, 30%. This is your credit utilization ratio. How much of your available credit you're using. The myth here, you need to keep it below 30%. The truth, below 10% is where the best score impact is. But obsessing over the exact percentage matters less than just not carrying large balances. Length of credit history, 15%. This is where the closing old cards hurts your score myth comes from. It's partially true, but only if you have few cards. If you have 5+ accounts, closing one rarely moves the needle meaningfully. New credit, 10%. Each hard inquiry drops your score 3 to 5 points temporarily. This recovers in 6 to 12 months. Stop avoiding credit applications out of fear of this. Credit mix, 10%. Having different types of credit cards, loans, mortgage, marginally helps. Not worth manufacturing debt just for mixed diversity. One of the most expensive myths about credit is the fear of hard inquiries. People delay refinancing their mortgage, avoid shopping for better car loan rates, and skip applying for lower interest credit cards, all because they're afraid of losing a few points from an inquiry. Here is what the data actually shows. A single hard inquiry drops your score by 3 to 5 points on average. It recovers fully within 6 to 12 months. And for mortgage, auto, or student loan shopping, multiple inquiries within a 14 to 45 day window are counted as a single inquiry by FICO. That means you can shop 5 mortgage lenders in the same month and it counts as one inquiry. Not 5. The fear of inquiries costs people real money. The person who avoids refinancing their 7.2% mortgage to a 6.5% rate because they don't want to hurt their score is paying thousands of dollars per year in unnecessary interest to protect a number that will recover in 6 months. Shop for better rates. Apply when it makes financial sense. The inquiry effect is temporary. The interest savings are permanent. Here is the most important thing nobody tells you about credit scores. Above 760, the benefits flatten almost completely. A 760 FICO score gets you essentially the same mortgage rate as an 820. The same car loan rate. The same credit card APR. The meaningful thresholds are 580 subprime line, 620 FHA loan minimum, 680 decent rates, 720 good rates, 760 best available rates. If you are at 760 and obsessing over getting to 800, you are spending mental energy that will produce zero financial return. For any major financial decision, mortgage, car loan, refinancing, lenders now look as carefully at your debt-to-income ratio as your credit score. Your DTI is total monthly debt payments divided by gross monthly income. Under 36%, excellent. 36 to 43%, acceptable for most mortgages. Above 43%, you will struggle to qualify for competitive rates regardless of your credit score. A 720 credit score with a 28% DTI gets better loan terms than an 800 credit score with a 45% DTI. Every time. Reduce your DTI by paying down existing debt, especially car loans and credit card balances, before applying for a mortgage. That is more impactful than any credit optimization. Move 1. Automate every minimum payment. Every missed payment stays on your report for 7 years. One missed payment can drop your score 80 to 100 points. This is the only credit catastrophe worth preventing. Move 2. Get your utilization under 10% before any major loan application. Pay down balances in the 60 days before you apply. This has the fastest score impact of any action. Move 3. Request a credit limit increase on your oldest card. If you are approved without a hard inquiry, most issuers do this, your utilization ratio improves automatically without changing your balance. The credit score is a tool. Use it. Don't worship it. And never pay a bank interest just to keep your number high. Let me show you exactly what the difference between a 680 and a 760 credit score costs you in real money on a mortgage. On a $350,000 home with 10% down, a $315,000 mortgage, the difference between a 680 score and a 760 score is approximately 0.5 to 0.75 percentage points in interest rate. That is not dramatic sounding. Let me show you what it means. At 7% on a 30-year mortgage, monthly payment $2,096. Total interest paid over 30 years, $440,000. At 7.5%, the rate you'd get with a 680 instead of 760, monthly payment $2,202. Total interest paid, $477,000. The difference, $37,000 in additional interest. Plus $106 higher monthly payment. Over 30 years, that is real money. But here is the critical insight: the jump from 680 to 760 produces this gain. The jump from 760 to 820 produces almost nothing. Focus your energy on crossing the meaningful thresholds, not on chasing the perfect number. One more thing costing people money: paid credit monitoring services. The average American pays $17 to $25 per month for credit monitoring. That is $200 to $300 per year for information you can get for free. By law, you are entitled to one free credit report per year from each of the 3 bureaus, Experian, TransUnion, and Equifax, through annualcreditreport.com. That is the only government-mandated free source. Not the commercial sites that advertise free and then charge you monthly. Pull one bureau every 4 months on rotation. January, Experian. May, TransUnion. September, Equifax. You have continuous coverage at zero cost. For fraud monitoring beyond that, your credit card issuer almost certainly offers free monitoring as a cardholder benefit. Check your app before paying for a separate service. The credit score is a tool. Use it. Don't worship it. And never pay a bank interest or a monitoring service just to keep a number high. Next video, the salary negotiation framework that gets 20% more in 30 days. That's here. Word count 1 200 duration 9 minute end card V9 salary negotiation.